Awesome, awesome. Good morning, my man. Good
Good
morning.
morning, brother.
Yeah,
Did you think I was gonna sleep this morning? I saw you sent me a text,
yeah,
but
yeah.
I
No.
I
Figured
I
you'd
don't
be
keep
up.
my phone in my room. Like I keep it in my office. So I was like getting coffee downstairs. You know what I mean? I didn't come in the office until like in here in my office until like 6:30.
Yeah.
So that's when
Okay,
I
cool.
reply back right now.
Yeah, I do that too. I started leaving the phones outside of the bedroom,
Hmm. Yeah.
um, just to unplug entirely for the night before
Hmm.
sleep and after sleep.
Yeah. Before I go to bed. I put in my office and I don't look at them.
Yeah, that's awesome. That's awesome. Well, we had some technical difficulties getting on at first, but we're here now for the first episode of the DM, Florida Real Estate Daily Memo. So I'm super excited for us to get this started. I think it's long overdue since our last video. Just to introduce ourselves, I'm Robert Morillo, and I'm here with superstar mortgage originator. Go ahead, introduce yourself, John.
Yeah, John Sepulveda here, and MLS 1309244 from Origin Point. Good to be here and sharing some time with you this morning, man.
Yeah, definitely, definitely. So we've come together to go ahead and bring to you guys the DM, pretty much a daily memo letting you guys know what's happening in the market. You know, still one of the number one things that's been happening for buyers is, just being so much on the fence due to interest rates. And, we've got a lot of I guess updates to provide with the audience, just to give you guys information and let you all know, what is happening so that you can make the best decision, the most informed decisions with the shifts that are occurring in the market. So, what do you want to go ahead and get started with, John?
So let me share my screen, and I can start uh, giving you some information about the current market. And it's really, even though rates are high and you hear all this hype on the news and all these things about a crash and what's happening and, doom and gloom and all this stuff, it's actually a really good time for buyers to buy. And there's a small window of opportunity still that will allow some people to, if they act now, they are able to, perhaps get in before the market switches. And I'm going to provide some information that I got from MBS Highway, which is a really good source of info that I utilize, and just give people an idea of what's happening in the market, sort of what the state of the market is now, and sort of inflation and rates, etc. So we can get an idea and get some information out to people. If that sounds good to you, Robert.
Yeah, that sounds good to me. Now, real quick, very briefly, before we get into it, what when you say before the market switches, what do we mean by that exactly?
Well, there's right now rates are high, right? And people are on the fence and people are holding.
Mhm.
And the data shows that there is going to be a shift coming, and that's what I'm going to explain to you in this presentation I put together. That's what the data points to, right? The data kind of leads the way, and you know what to expect, right? That I can't predict the future, and I can't guarantee that's going to happen, but the data points that way. And I just want to make most people are not aware of this stuff. Like, this stuff is happening, and people just are living their lives daily and not really aware what's happening. It's all related to, Silicon Valley Bank and all this stuff that's happening. It's all related to this. So this
Okay.
hopefully will give people some information about what's going on, and provide people with the tools to make a decision to hold or not on buying a house, but with real information, not just what they hear in the news is doom and gloom and that's it.
Yeah, I'm glad you mentioned that because I have been seeing those bank collapses on the news, or hearing about them through social media, but I'm gonna be honest, I don't know entirely what that's all about. So I'm glad we'll be getting some
I
insight.
will give a two or 3 minute summary and try to explain in plain, English exactly what that's about.
Okay, awesome, awesome. So let's go right into it whenever
Let's
you're
do it.
ready.
All right. So as we know, inflate. Can you see my screen, by the way?
Yeah, I can
Yeah.
see
All
it.
right. So as you know, inflation's on the way down, right? We can see it. It's still high. Costs are still high when you go to the grocery store, but it's kind of leveled off. And if you can see on this chart, March of a year ago, it was about 6.4%. If you see on the on the left hand side, and on the right hand side, January of 2023, that's where we're at now, right? That line points to sort of that. This is important because what the Fed does when they decide if they're going to hike rates or not, and there's a meeting next week and on the Fed, and we'll talk about that in a second, how this is a very, very important week for the financial system and the mortgage and real estate industry. So the Fed decides, and the Fed has a number of 2%, and which is where they want inflation to be at. That's where it always is, supposedly, and that's where they want it to be at. So right now we are at 5.5%, 5.4%. I forget what the last number was. That's where we're currently. We were as high as like 11%, when this whole thing started. So, it's definitely been going down. What happens is what the Fed does is, right, they use all different costs in the economy. Shelter cost is one of those units or measures that they utilize, right, to come up with what the CPI index is and, just sort of what the economy is doing. So shelter costs are accounted for in these reports that they do every month. The problem is that shelter costs are lagging, meaning they show up afterwards, right? So if you think about this, if you see this image, the roller coaster, the guy in the front cart, they are current housing costs. But the Fed is looking at the report and he's looking at the cost of the housing, the shelter cost of the guy in the last cart of the roller coaster. So they haven't come up yet. The front cart made it over, but the last cart has not yet. So if you look at this chart,
Yeah.
the pink is current shelter cost, right? So the pink is the real shelter costs, the guy in the front, right? That's that pink line right here. So right now it's about 3%. If we can see here on the screen, right? January 23, that's where we're at now. If we add the blue line, this is the CPI index, right? This is what the Fed looks at year over year. This is this blue line right here. This is where that reading was last month, 7.9. And that's because the 7.9 that the Fed is looking at is the guy in the last cart on the roller coaster. He hasn't gotten to the top yet. But the real shelter costs are here in the front of the roller coaster. We've already gone over the hump, right? So it's like the Fed, what the Fed is doing is the Fed is setting policy, driving forward, looking at the rearview mirror. That's how they're setting policy. And that's how they always set policy. If you remember about a year ago in the news, when this whole thing, when the inflation started, if you recall, the Fed and the Secretary of the Treasury were saying in rhythm, no inflation. Then they went to transitory. It's transitory. Like that was the language they used. Then when they realized, oh crap, we're in trouble, they started using the word soft landing. And we're going to have a soft landing. I'm sure you heard that in the news because that's what all the news was saying. Soft landing, soft landing. Soft landing means, it's going to be easy and people are not going to feel the pain. Right. So that's one thing they've been saying. However, the Fed, if you go back and every single meeting the Fed's had since they started raising rates a year ago, the Fed has said in every meeting, this is going to be painful. This is going to be painful. We're not going to stop. This is going to be painful. Every single meeting, he's used those words. It's going to be painful. There's going to be pain. People are going to feel pain. Because what happens is,
go ahead.
What happens is in order to bring down inflation, the Fed has to stop, number one, the QE, right? The easing and the printing of money that they were doing. They're actually taking money out of the system. I think it's 95 million a year. It's the number that they've been taken out of the system, right? So that there's less money and there's less demands for things and for items, right? And then that's what brings inflation down, because less people, now there's a lot of money, so people want things. The supply chain issues, they pay more money. You saw it in housing, there was not a lot of inventory. They paid extra because they had the extra money, right? That brought up the pricing. That's what inflation is, right? So what the Fed is trying to do is just bring inflation down by cutting like the demand, the people wanting to buy stuff. And the way that's done is they raise the interest rates, overnight lending that banks lend to each other. We were at 0 for 15 years. And in a year, we've gone from 0 to 4.5. So that's really fast, right? That's just too fast. And there hasn't been enough time in the market for that to take place. So what happens is something breaks. Like when the Fed keeps on raising the rates and doing that to the economy, something's going to break. It'll happen eventually. The issue has been nobody's known what was going to break. They just knew something was going to break. At the same time, it's been, so people are saying this is going to be like 2008, right? Housing, and there's doom and gloom, and it's going to happen again. So people, number one, are on the sidelines because they're thinking, okay, the market's going to crash and property values are going to lose their value and it's going to happen again. And then you have the really high interest rates, right? So that people are like, this is, I can't afford this house, I'm holding off. That's kind of what's feeding the people holding off, right? So at the same time, you have the economy sort of going on and the Fed trying to reduce and control. But they're looking, as I showed you already, the housing is a lagging indicator, right? So if you look at here, this is the blue line, right? That's what the Fed is using right now, 7.9%. And this pink line, purple line, is the real shelter cost at 3%. So the difference between those is 4.9%, right? If you look at the report that the Fed uses, shelter costs accounts for 43% of that entire report. So if the Fed was actually using the real shelter cost, the difference is 4.9%, and it's just 43% of the report. 2% would be that's the number, right? The difference between 7.9 and 3 is 4.9, and you multiply that by 43%, which is what's used on the report. That equals 2%. So the real rate, instead of 5.5, should be 3.5 if you reduce this number here, right? The real number versus the lagging number. The pink is the front of the cart in the roller coaster. The blue is the back of the cart in the roller coaster. So if the Fed used the real number, the current housing, the front of the cart, inflation would really be 3.5% right now, instead of the 5.5% that the Fed is using as a number of inflation. You follow me?
So my question is why?
Why do they do that?
Why are they reporting from the end of the cart?
That's the $1 million question. And you have all these analysts and all these people pointing exactly the same thing I'm saying, and the Fed continues going forward. So that's what's happening, right? And so that's one part. At the same time, the market is betting that the Fed is going to pivot. You probably heard these words on the news as well. Pivot, right? Pivot means that he's going to stop raising rates and either pause or start cutting rates. That's the pivot. So the market has been saying the Fed's going to pivot, the Fed's going to pivot, the Fed's going to pivot. And every meeting, the Fed has been saying, I'm not going to do it. There's going to be pain. There's going to be pain, right? That's kind of the battle that's happening now. So the Fed is too far into this. The Fed is not, if he pivots, he's going to look bad because he's been saying for a year, there's going to be pain, there's going to be pain. So now you add,
if they do pivot, will there be relief?
If they do pivot, the rates are going to start going down because the rates are tied to the rates are going to go down, but the rates are going to go down regardless, because historically, when inflation goes down, interest rates go down. That's just something that happens historically. And if you see in the market since last week, when Silicon Valley started happening, the rates started going down because people are leaving. The mortgage rates are tied to the 10-year Treasury bond, and that's a safe investment, right? So traditionally, the stock market pays more than the bonds. But currently, because the market is so up and down, people are starting to get nervous. They got nervous last week, and they started pulling the money from the market and put it into bonds. So that created demand for bonds, and that brought the bond pricing down. And last week, we saw the rates came down. So that's kind of how those things are tied together. So the Fed has been kind of saying, we're going to have pain, we're going to have pain. The market has been saying he's going to pivot, he's going to pivot, he's going to pivot. And then now we have the Silicon Valley debacle that happened, right? And basically what happened with that is the bank, this is what's coming out, right? The reports that are coming out is banks hold about 10% of the deposits. That's what the law says. So they take the money, they keep 10%, and then the rest they invest. The other 90%, they invest it in, they do car loans, mortgage loans, and they invest some of that money, right? They don't actually keep the depositors' money 100% on their account. They keep 10, they invest 90, and that's how banks make money, right? So what banks did is they took some of this money and they put it into bonds, and they bought long-term bonds. All this stuff that's been happening, there's another term that you might have heard called the inverted yield curve. And what that happens is,
I have not heard that term. I don't know what it means.
all right, so I'll tell you what the inverted yield curve means. The inverted yield curve is, and every time there's been an inverted yield curve, there's always been a recession, right? That's just the certain things that always happen. That's one of those. The inverted yield curve means is that you take the 2-year treasury bond and you take the 10-year treasury bond, and the 2-year, right? So the way it works, if you take your money, you invest it for 2 years, you get an amount of interest, right? And if you invest it for 10 years, you get traditionally a higher amount of interest because you're tying up your money for longer term. What's been happening for the past year, that yield curve has been inverted. That means backwards. So they've been paying more money for the 2-year than the 10-year. So if I take a 10-year, it's giving me less money than the 2-year, which doesn't make any sense, right? Because why would you tie up money for long term?
Yeah, exactly. Why allow it to be tied up for longer when
you're going to make less?
Yeah,
right. That's just because it's still safe. 2 years, 10 years as a treasury bond. The government backs it up. The government is always going to pay because they can always print the money if something happens. So there's no worry with that. But the 2-year should be paying less money than the 10-year. But it's inverted, so it has not been doing that. Right.
So now the treasury bonds, are they something that you can borrow against?
Banks could theoretically, not people, but or investors, I guess they could theoretically, but it's just not. It's just something that they take the money and they place it there. So what happened in Silicon Valley is they had this money, a very large amount of money, into these 10-year bonds. Okay. So the money's tied up there, right? So, and because the bond pricing has been changing, so now that investment is worth less, right? So I'm going to make up numbers just so kind of for the ease, right? So let's say they invested 100 billion in these bonds, right? But because in their 10-year bonds, so after 10 years, they're going to get their 100 million, and the interest, but they got to wait out. Currently, because of the market, those bonds are worth less.
Okay.
Right. So, and they realize the loss on paper. So that loss is there on paper, but they don't really realize the loss because they haven't sold the bond. They haven't cashed them out. So they still have the bonds, and all they got to do is wait it out. What happened with Silicon Valley was that somebody put on, somebody leaked it, somebody said something, and the depositors got nervous. And,
so they pulled out.
And they went to the bank. It's called a bank run. You might have heard that term in the news. They made a bank run. That means people went to the bank to take their money out, but they all went
and there wasn't enough.
There wasn't enough because they only have 10% of the assets. So they started pulling out, money. They started pulling money out. So they went and sold some of the positions to be able to cover it. And then in that process, somehow, that somebody found out about it, and then they made a big thing about it, and then people ran to the bank to get their money out, and they don't have enough money, so they had to stop and pull it out.
Okay, so now the bank collapsing makes news. I would imagine other peoples that are depositors in other banks are now nervous. Is there a cure for the Silicon Valley Bank? Is there a cure to this situation?
Well, I mean, that's a complicated subject, right? Because because here's what's happening, right? So then you got to throw the politics into this, right? And I'm not talking about politics and political parties or anything like that. I'm just kind of relating what the news are, right? So the the depositors and the people that utilized this bank was a lot of, venture capitalists, and they had quite a little thing going, right? So the venture capitalists lend, give the money to startups, but the requirement from the bank, so the bank lent the money out, like, because the startups used Silicon Valley Bank, and they give a startup the monies, right? So you're starting a business.
I heard
So
they were being very friendly with
certain
startups over
certain
there.
right, they were very friendly with, with certain ideologies and certain things that were happening, but that's okay. But what the bank was doing was telling the people, okay, we'll lend you the money, but you got to keep your money here in the bank. So you had all these startups that had all their money in the bank that were just starting, so they had the money in the bank. You had, I guess, I read 90% of the wineries in California bank at Silicon Valley Bank. The deposits, FDIC insurance covers depositors for $250,000. Anything above $250,000, it's not covered by FDIC insurance. You shouldn't put that much money into, like, you know what I mean? There's other vehicles that companies should keep that large amount of money in, but that's a different conversation. But 250 is the number. So the concern was over the weekend, right? This happened on Friday because it always happens on a weekend, never happens during the week because they got to have time during the weekend to figure out what to do. And so the concern was, like, with the wineries on Monday, wineries were going to have no money because on Friday they said there's no money. We close the bank, and what happens is the depositors. What the reality is, the depositors 250,000, you're protected. FDIC insurance covers you. The rest, they have to sell the assets, and then they have to divide it by all the depositors. So they get 70, if they're lucky, 70-80% of the dollar whenever they sell the assets down the road. That's what happens traditionally with a bank that size if it were to fail, right? There's some that you might have heard the term too big to fail. So there's like the big four, JP Morgan and Wells and BA, like there's these big banks that they say we can't let them fail. But this is one that's a smaller bank, theoretically it could, and the law says, yeah, it's fine. What the government did over the weekend was first they're trying to find a buyer for it, and they couldn't do it. And what the government decided to do, what the Fed decided to do, was they bailed out Silicon Valley Bank. Basically, they said, all right, here's what we're going to do. We're going to give you a loan. It's for a year, and we're going to give you 100% of the money you have tied up in bonds. So you have some leverage, right? Which, okay, that's great, but what's going to happen afterwards, right? But let's not worry about that. Let's worry about that right now, right? So basically the bank said to all the depositors, there's $220 billion that depositors had into Silicon Valley Bank. They basically said to the bank, we're going to cover you. Like, don't worry, your money's safe. We're going to give it all to you.
But up to that 250 limit, right?
No, that's the FDIC insurance. The government said the full amount. So there's a Chinese investor that has $100 billion in there. His $100 billion are covered.
What?
Yeah. So that's what's going on, right? So that's there. So that's not, which is fine, right? So that brings us to the next point of why I said earlier, like, this week is super important week for the industry, right? Because the Fed has been saying it's going to be pain, it's going to be pain. I'm going to rise. We still need to, the rates need to keep on increasing. The market had priced in 50 basis points at next week's meeting before the Silicon Valley thing collapsed. They were thinking the Fed speak was he was going to raise 50 bips on next week's meeting. Now Silicon Valley happens, right? So if they keep on raising the rates, the reason why that Silicon Valley and that happened is because the rates have been increasing so fast and the market's changing so fast, right? So if he does another quarter, if he does 50 bips, I mean, the market, God knows what will happen to the market, right? So hopefully he doesn't do 50. Now it's at 25 or no, or, so a whole bunch of people in the market are saying, you got to hold, you got to hold, you got to hold. But they've been saying that for a few months now. So if he holds, pauses, does not increase anything, we'll see what happens. If he raises a quarter, that's just going to put more pressure on the market, and it's going to put more pressure on the banks. So the Fed has to decide this week, what am I going to do? Do I backtrack what I've been saying that there's going to be pain and I'm not budging, or does he pause? And that's where the market's at this week. Like, that's the point right now with the market. It's kind of, what's the Fed going to do? And nobody knows.
Yeah.
because he's been driving, looking at the rearview mirror all along, and they've been wrong. I mean, they were wrong in printing all the money. They said it was no problem, no inflation. Inflation's not a problem. We don't have to worry about it. And obviously we did.
Yeah.
Then he said, like I said earlier, there's no, it's transitory. Then they went to, it's a soft landing. Now we're in this mess, right? That's kind of boiling, and it's all coming. It's all boiling, and it's all coming because he needs to decide, is he gonna pause? So everybody, like all the people on, saying you should pause. Some people are saying you got to start cutting rates.
Mm-hmm.
The problem is that we got another problem, right? Which is related to Silicon Valley. They've been taking money out of circulation for better part of a year now. In this,
Mm-hmm.
They raising rates and taking money out to stabilize the market, and they stopped printing new money, right? They haven't printed new money because all they've done in the past, all the stimulus money for the pandemic, all this, it's money that they've printed, right? It's new money that the Fed has printed. So now they're going to say this bank had $219 billion in assets that they lost. They pretty much lost everything. So they have to print the money. They don't have the money, so they got to go back to printing the money for Silicon Valley Bank. Like, they're going to have to print that money because it's not there.
Yeah.
So that counters what the Fed has been doing for the past year, right? Because they've been not printing money. They were taking money out of circulation, but now they're going to print more. They have to print more. They have to re-inject money to deal with Silicon Valley. So all that, work that's been done kind of gets wiped out because they're going to put the money right back into the system again. They're going to print new money again. So that money.
My question is all of this curation going to, like, let's just say that money that's being printed for Silicon Valley, one, is there any checks and balances going on with the executives who are making the decisions that caused the bank to collapse in the first place? And two, does that mean any other bank, because there are more than one that have experienced a collapse, are all of these banks going to be bailed out? Are all of these banks going to be going through the same thing? Like, what is so special about Silicon Valley are they going to be the only ones that are bailed out like this? Is the Fed only going to print money for them only? Or is it going to happen across the board?
Well, so that's the question of the other investors, right? So
then where does it end?
There's three banks that fail. So there's another bank that failed called Signature Bank.
Okay.
Failed at the same time, that weekend. Now, just for additional kind of reference, right? So the board, people in the board of the bank, I don't remember there's so much data that I've in my mind. So the details, the name and the title of the person, I don't really remember, but one of the people from Silicon Valley Bank,
board of directors,
either the CEO or the board, somebody from the board is on the San Francisco Fed.
Okay.
The governor of California's wife has a business tied to the wineries. They banked in that bank.
Gotcha. So essentially a couple of influencers.
Well, there's more than a couple. There's a whole bunch of them. And they all happen to be from the same political party that's in the White House. So they got the aid. Signature Bank in New York. Have you heard of Dodd-Frank Act?
Yes, I have heard of it.
This is thing that they did in 2008 after the collapse. And there was two gentlemen who put the Dodd-Frank Act together. One of them, the Frank part, is Barney Frank. He used to be a congressman from Massachusetts. He's the one that put that, like, he put that together, like, that big, and it's all regulation, and that affects us obviously in the banking and the mortgage industry. He's on the board. He's no longer in Congress. He's on the board of Signature Bank.
Got it.
They got bailed out. So now First Republic, it's another bank that's in California that is stumbling, and the stock last week just kind of came crashing down. But the government can't go and start printing money for all the things. So what they did was they convinced 11 other large banks to deposit $30 billion of their assets into First Republic for 120 days. They deposited, they took their money and deposited the other banks, 11 other banks, and 30 billion. They did it, the bigger ones put more money than the smaller ones, but they put 30 billion total. They deposited into First Republic for 120 days to try to give it some legs, to try to hold out. Wonderful. It's a band-aid. The question is, what happens in 120 days when these people got to take the money? They got to get the money back, the other banks.
Right.
And then First Republic, they lost all their money. Like everything they had, it's up in smoke. So the stock, the value of the stock is it's really worthless, right? Would you buy? They have the name, like there's a name to it, but there's no, Signature Bank. Like this, they have a name, but they don't really have anything else. Signature Bank they got offered. They're going to get bought out by another bank. I forget the other. There's another bank that's buying them, trying to save it and try to do it at the same time. In Europe, it's going on the same thing. In Credit Suisse, they got bought out yesterday by another bank in Switzerland. People lost a lot of money. The stocks were like $1.81, and they're buying them for or they selling them for like 78 cents. I mean, they lost a lot of money since last Friday. Like the investors are losing a lot of money, but they're buying this. Credit Suisse is getting bought out to protect it, to try to save it from failing, because that's a very large bank in Europe that would affect the market a lot. Right. So you got all this stuff going on, right? Very important week because of what I've just been explaining on what's happening. Right.
Yeah.
So that's kind of the market, right? So now if we go back to this and back to the housing, right? Tie this all with housing, and the way I kind of started this thing and saying, okay, there's a window of opportunity to buy, right? So if you look at, this is a existing home, right? So some people say that, you have this issue with, we're going to have this issue with the market, like 2008, the market's going to crash, et cetera. In 2008, 2007, you see this graphic here, there was 4 million homes in inventory in the United States. That's how much inventory was, right? So that's what part of what fed the housing crisis that we had in 2008, because of 4 million homes.
This data report is based on nationwide statistics, not
correct. Nationwide, yeah. Okay. Yeah, this is nationwide, yeah.
Okay.
So, but it relates. It's correlated because it's right. So in 2007, there were 4 million homes. And in 2023, there's 980,000 homes in the market in inventory. That's the current inventory. So obviously very different. 4 million and 980, that's a very different number, right? So there's a difference in the current inventory, right?
Huge difference, like a 3 plus
3 million. Well, and it's actually more than that, because here's the real. Now I'm going to give you the real story, right? 980 in inventory, but there's 402 under contract or off the market.
Okay.
So there's really 578,000 listings in the country.
Oh, I thought when you said 402,000, I thought you meant on top of the 980. You're talking about of that 980, there's 402,000 under contract
or off the market for whatever reason.
Yeah.
So that's 578 is the figure that's nationwide of listings.
Wow. Of
annual household formations, which is what happens when, like a couple gets married, they go move out, or somebody moves from their parents' home and they move into their own, or something happens, a new household is formed, right? When a young, person moves out from their parents' homes, the parents' home stays there. That doesn't disappear. They just go form a new one. They move in with their roommates, they live by themselves, they get married, whatever they do, right? They form a new household. The expectation of new household formations in this year is 1.9 million in the country. So if 1.9 million new households are going to be formed, there's only 578,000 available. Last month's permits, new construction single family permits, was 1.3 million.
So that's
going to be in the future. There's a shortage of inventory, which so brings me to my kind of what I said originally of, what it's a good time to do this now, right? To buy now. And if you look at this example that I kind of, that's here on this thing, you take a house that's, 500,000, do a 400,000 loan amount. Rates have gone up about 1% over a year. They've actually, last week they went down, so it's not, 1 whole percent now, but the math, like, let's do the math. So if we do $100,000, right? $400,000 loan, right?
Yeah,
And if
20%
we
down.
and if we do that 1%, just what the difference is, right? That raise in interest in 1%, that
Mhm,
equates to about $257 a year, right?
mhm.
A month, sorry, 3,000 a
Mm.
year. Um, what's happening now is we are sort of going down, right? We're at the peak. There are the rates sort of with the market. What's happening? Rates are kind of crazy. And if
Mhm,
you go back to that original slide with the roller coaster with the lagging indicator, right?
mhm.
On the May 10th report, that's going to come out, of the CPI report from May 10th.
That was gonna be one of my questions, but we'll get into that after. Go ahead, go ahead.
So on the May 10th report, the back of the roller coaster is going to make it over the hump. So on the
Okay.
May 10th report, they're going to have the roller coaster over the hump with the real housing numbers. They're not that lagging indicator. It's not going to be lagging anymore May 10th.
It's
That's what
gonna
they're
be
going to be
caught
looking
up.
at. Now, the real number is going to be different, but they're not going to be looking at the real number. They're going to be looking at the last card in the roller coaster. So
Mhm.
on May 10th, that last card, that data it's there, and the CPI index is tied to it. So if he doesn't do it by then, if he doesn't pivot, he doesn't stop by then, if he has not done it by then, May 10th, it's gonna have to happen because that data is going to be there, and the inflation is going to be way down, and he's going to like, oh my God, inflation is 3.5%,
It's
and
in a sense, it's kind of like you're predicting the future, and it sounds like, the Fed is gonna experience some whiplash.
if like now that may change, right?
Yeah.
That May 10th date might change to this week because this is a crucial week
Okay, so
in what he decides.
you're saying that the agenda is being hyper accelerated due to the current circumstances in the market.
It it may.
Could be,
We
could be.
don't know. We don't know what the
Yeah.
Fed's going to do, right? Like everything points to the Fed. Hey man, you got to stop doing this. You're going to break some like you're going to create some major damage,
Mhm.
which they may have already. We don't know, right? We
Might
don't
be
know
too
because now
late
people are saying
for
now they went from soft landing to they're going to have a recession at the end of the year. Like now the talk's starting to change. But there's been talk of a recession for over a year. Like it's not new. The data is there. The yield has been inverted for a year. Like all this data is here, and all you just got to look at it.
yeah.
So just to kind of finish this up, right? So the market, if you now, right, assuming sort of where the market's still at now, there's less buyers currently in the market, right? And I say less
Quote. Okay,
because
so it's not that there's less buyers. The demand is too strong, but there's less people inclined to buy because of the cost of
of
buying.
the market, there's more buyers on the sidelines
Hmm.
because they're afraid. They're afraid of 2008 happening again and people losing their homes and being upside down. That's a big
Hmm.
fear. As I showed you with the numbers, there's no inventory. There's not enough inventory for that to happen, right?
Hmm.
4 million in 2008, whole different picture, whole different world. So buyers are on the sideline because they think they're afraid that the market's going to crash. And actually, from speaking to buyers, it's not even. I get the sense that it's not that they're afraid that they're going to lose their money. They're waiting for prices. They think prices are going to go down, and they're waiting to cash in and buy real cheap, like they did in the past, like people did in the past. It's
Hmm.
more that like when I talk to people, it's more I'm waiting for the prices to go down than I'm afraid of losing money, right?
Yeah, yeah,
And
yeah.
unfortunately, they're incorrect in both instances because they're not going to go down.
And
As you,
and and that phrase right there, I'm afraid of losing money. Like, you're basically saying I'd rather lose money in rent than to own and risk my property's value going down instead of up.
correct. So now there's more people on the sidelines. So what I mean by this is a good time and there's a small window to if people buy now is there's less demand, right? There's still multiple offers, I'm sure you know, there's still multiple offers on properties,
Oh,
but it's
absolutely.
but it's
Especially on
but
homes under 300,000, under 400,000. The multiple offer situations are still there.
It's still happening, but it's a different beast than it was last year. Right,
Mhm.
the multiple offers before were like like they put the auto what is the auto the clause in that increases automatically, the pricing goes up to, so
Yeah, the
people were
price
just
the price escalation clause.
price escalation clause, thank you. And so that automatically, people was just, not even the people, the clause was just raising the property prices by itself, right? I mean, that's insane. So you're not
Mhm.
really seeing that now. So there's more opportunity in certain properties, because there's some hot properties and some places that's not going to be possible, but there is an increased opportunity for a buyer to go in there and negotiate.
Mhm.
Whether
Absolutely.
it's, price reduction, which is kind of more complicated. Sellers don't want to do as much, but there's more opportunity as in money or what the seller's giving, contributing in the closing costs, right?
Yeah.
So there's an opportunity for a 2% discount. That's pretty standard. Somebody goes in and they put 2% for closing costs, 3% for closing costs, and that's being accepted. Where a year and a half ago, that wasn't even like part of the conversation. The sellers were like, "Are you crazy? I'm not giving you any money. You got to give me more money." Now the
Mhm.
sellers are contemplating giving this back to people, right? So
Yeah, no, and
it's
now
money.
I see the difference. I feel the difference when I walk into a home, the seller's there and they're like just it's like they're almost grateful to just get what they're asking for and willing to, give back.
To give back something, negotiate, right? So
Yeah.
you take the scenario, right? 400,000 the mortgage, right? The rates went up by 1%, so it's about 3,000 a year. But if they act, they go now, they negotiate, they can get a 2% discount. That's not a crazy number, getting 2%, right?
Mhm.
Um, we've had 120 straight months of appreciation. Like every year, like the property values have increased, right? It's,
Mhm.
it went, I don't have the number off the top of my head, like, last year went up 19%, or 2021 it went 19%, and in 2022 it only went up 6%. Like, so the market's not losing money, it's just not making as much, right? So, but when between prices sort of stabilizing and interest rates dropping, the buyers that are on the sideline are going to come back in the market, and that's going to spur the movement, and the property values are going to maintain. So even
Mhm.
if they do a 3%, if you do a 3%, which is very low, 3% appreciation of the property, that's $15,000, right?
Mhm.
So you get 2% from the seller, 10 grand. Your property appreciates 3%. That's 15. That's 25 grand. You refi, you buy now, higher rate. You refi to bring the cost down, cost you 5,000. You still
Mhm.
benefit. You still get 20 grand, under this scenario that I'm painting, right? So what I'm trying to paint is with some very conservative numbers, some numbers that are not like really, 6%, return on investment, like very basic numbers. You refi, you spend the money to refi, you're still making money at the end. Like you're still on the positive. So back to what you just said earlier, people are afraid of losing money. They're not afraid of losing rent, but they're afraid
Mhm.
of losing money. But on some very simple math, it makes sense, right? So I have the saying, liars figure, figures don't lie. I mean, the number is telling you you have an opportunity to buy home.
Absolutely. Absolutely, absolutely. So what is it that we can anticipate for this week for us
Well,
to understand what like when are we gonna circle back around on this first conversation that we're having?
I'll update
The
everybody
DM?
every morning. Every morning, I'm going to give an update to everybody on what's happening.
Okay.
So, I can only do the day before, obviously, right? So, tomorrow morning I'll update what's happening today, and so on and so forth. So Fed's meeting, Tuesday and Wednesday. So it's going to be interesting. It's going to be visual. I mean, now nobody really everybody's expecting the Fed. Okay, a lot of people are saying he's going to stop. He's going to
Mhm.
pause.
Mhm.
And some other people are saying, no, he's been saying no. He's been saying there's going to be and there's a blackout period, so they can't talk to the press. So there's a big uncertainty. Like nobody knows what's happening. So it's going
So
to be an
yeah, 'cause
interesting week for sure.
your logo is looking like a roller coaster right now.
Yeah.
So by Thursday, Friday, we should be able to know something related to what's happening with the Fed and
Oh, yeah, absolutely Thursday.
have
Yeah,
an
absolutely.
idea of what
Yeah.
direction we're gonna be going in.
Yeah. Well, we'll know if he raises. something's going to break further.
Okay.
And, you know, put your seatbelts on, because it's going to be, because
So
it's going to be, the market indicates and the data points to ugliness right now. It's going to be ugly.
so let's say with credit cards, cash advance loans, everything else that people are willing to finance with interest rates in the double digits or higher, right? The purchase of a vehicle. Um, do you see the housing market, interest rates in the housing market being anything over double digits?
The rates in the housing market are tied to the inflation. When
Okay.
inflation goes down, rates go down. Rates on the housing market are tied to the 10-year bond, very closely related.
Mm-hmm.
When the market is struggling, people leave the market and go into safety, and they go into bonds. So when there's a lot of demand for the bonds are going to go down. But 10-year bonds go down, mortgage rates go down. We ain't going to be at 10%.
Okay.
It's going to be,
And I think
now that we're not going to be at 2.5%. That's
mhm.
not happening again. You know, my mortgage at 2.49%. That's close to free money it's going to get, and it's not going. We're not going back there. I mean, unless something terrible happens in the market, we're not going back there. Not that the data doesn't point that we're going back to that. So we're going to be.
What do you think about the overall opinion? Everybody that, there's still this huge, overly anticipated market crash, right? That so many people have been waiting for since 2008, and the exact opposite has been happening. So now, like, the trajectory, I mean, with the level of demand that there is on the market and how little inventory there is, when you put both of them together, our homes going to appreciate even further. Let's just say, for instance, the people who did buy at the top of the market, even if buyers are getting $20,000 off in today's market, can they expect to see appreciation over the next few years?
100%, because the market has been appreciating. They got to wait. So right now, if you look at like,
gotta go up.
Right. So the ones that bought at the top, they got to wait a little, because the ones that bought at the top are the ones that are upside down now.
Mm-hmm.
Right. And
Okay.
especially now, there's some markets in the country that are more affected than others. Right. So we're in Florida. So
we're in Florida. Yeah.
we're only focusing on Florida. Florida, that's not what happened. There's some other places, some other states that, prices went crazy, and they're going to be in trouble.
Mm-hmm.
Just because the market has to adjust, because they went up too fast, too much. Here in Florida, we have there's 1,000 people moving here a day, and there's just the people are renting. I mean, it's moving. It's moving slowly. It's slower for sure, but it's definitely moving, and the buyers are there. The demand for housing is there. There's just not enough housing, and then, it's just a matter of, maneuvering the market. But I feel that the people that bought, they have to wait. If they sell, obviously they're not gonna get their money back. But if they hang on, once rates go down and the market adjusts, their properties will continue appreciating.
Okay, so what is the best piece of information you can offer to someone who's on the fence but definitely wants to apply moreover than seek out a place to rent? Like, they definitely want to explore the market before deciding to rent for another year.
Well, look at the numbers. Look at this, go back and watch this recording and do the math and look at the numbers. And, if you already have an agent and a lender you're working with, call them up and say, hey, how come you haven't given me this information before? And if, you want that information, give us a call, and we'll be glad to, walk buyers through this and, hold their hands and show them how this is, right? Because if you have the information, you can make decisions. It's really, if you have this information, I feel that this information that I just shared is very important. And I feel that most of the people have no clue that this is happening, even in the real estate industry, never mind buyers. So it's important information, and it's out there, right? It takes a lot of time to keep up with it, right? It takes a lot of work and effort. So, that's what it is, but the information's there. And if people have the tools and the information, they can make informed decisions.
Absolutely. All right. So I guess we're gonna get back at it tomorrow with episode number 2 of the DM. and we're gonna keep providing value and the accurate information to help people make informed decisions.
Absolutely.
Alrighty, so I'm Robert Morillo with Team Aroa at Compass, Florida. License number BK33733543. You can reach me at 407-209-7409 or Robert Morillo at compass.com. Go ahead, John. Go ahead and sign off.
And thanks everybody for, I hope this information is valuable. We'll, looking forward to providing this on a daily, these updates on a daily basis to everybody. John Sepulveda, Origin Point, NMLS 1309244. You can contact me. My cell number 617-899-0486.
Alrighty then, John. We'll be talking tomorrow, and I look forward to hearing from you soon.
And we'll be talking. Talk to you later.